Hello traders, welcome back to Nova channel and let's continue another new topic today. A fresh outlook from Goldman Sachs is once again shaking the gold market, reinforcing the belief that the bullish story of gold is far from over. Goldman Sachs expects gold prices to rise by approximately 14% from current levels, reaching around $4,900 level per ounce by December 2026 under its base case scenario. According to the bank, the main drivers behind this outlook are the structural demand from central banks, combined with political tailwinds from expected U.S. Federal Reserve interest rate cuts. In a lower interest rate environment, gold becomes significantly more attractive as a defensive and capital-preserving asset. Goldman Sachs emphasized that falling yields reduce the opportunity cost of holding gold, with historical support higher prices. Beyond this, the bank also highlights a key upside risk. A portfolio diversification trends extend more aggressively into a retail investor segment. Gold prices could rise even faster than projected. Also, according to the head of commodities research at Goldman Sachs, this points out that gold market is relatively small compared to the global bull market. This means that even a modest reallocation of capital from bonds into gold could have a disproportionately large impact on prices. This structure imbalance explains why Goldman Sachs continue to rank gold at a top long-term commodity allocation. Even under conservative assumptions, gold maintains strong upside potential, while in periods of macro uncertainty, geopolitical tensions, or financial stress, its role as a hedge becomes even more valuable. Moreover, Goldman Sachs forecasts the central bank will purchase an average of 80 tons of gold in 2025 and 70 tons in 2026, maintaining steady structural demand. Meanwhile, Western gold ETF are expected to increase their holdings as the Federal Reserve begins cut rates, with a cumulative 100 basis points of rate cuts anticipated by second quarter 2026. The recent rally in gold prices has already been supported by a combination of strong central bank buying, ETF inflows, a weaker US dollar, and rising interest from individual investors seeking protection against the trade risk and geopolitical uncertainty. Importantly, Goldman notes that current Western ETF holdings are now broadly aligned with what could be expected given U.S. interest rate level. This suggests that ETF inflows are not excessive or speculative, but rather consistent with macro fundamentals. Last but not least, a message for gold traders and scalpers I would like to send to you. What's the long-term forecast paint a bullish picture? Gold traders, especially scalpers and short-term traders, should remain disciplined. Strong fundamentals can fuel powerful trends, but they also create sharp volatility, liquidity hunts, and false breakouts, particularly around key news events and interest rate expectations. For gold traders, the priorities should always be risk management first, profit second. Expect the key liquidity zone. Be cautious during news-driven spikes and avoid over-leveraging just because the macro narrative is bullish. Gold rewards patience and precision, but it punishes emotional trading faster than almost any other market. In times of major macro shifts like Fed rate cuts and structural demand surges, the traders who survive and grow are not the ones who chase headlines, but those who understand the market behavior, manage risk tightly, and trade with a clear edge. And that is the topic today. Thank you so much for your watching, and don't forget to like and subscribe Nova Scalper to receive more useful videos for your trading journey. Happy trading and see you in the next video.